What's up, everyone? I hope you guys had an amazing day. Today, the market was much better. We had a lot more plays to play. Obviously, the implied volatility on the contracts were much higher, but regardless, there were a lot more plays that we took. So it was a good trading day regardless. So let's get started with the video. Basically, tomorrow morning, we have to remember that we have news coming out at 8:30 a.m. Core PCE price and unemployment claims. And then at 10 a.m. we get the ISM manufacturing PMI data. So two pieces of info early on into the morning. Obviously, now the market bounced like $15 intraday. So all of this happened because, the Fed, right? So basically, Powell basically told the market a 50 basis point hike in December is in the cards. But his reiteration that the Fed will be maintaining rates at the peak for some time still suggests to us that additional yield curve inversion via bull flattening is possible near term. We still think curve inversion will remain a feature of the bond market for most of 2023. So he's like, oh, look, 50 basis point hike in December. But then he just tried to reiterate that all of this is still going to affect into the next year, right? And then he went on to say Powell has sounded more hawkish than the typical FOMC participant. Notably, he appears less confident than some in the November FOMC minutes that wage growth has cooled. Whatever. But he hinted labor supply is unlikely to grow anytime soon, and the Fed will have to bring down demand or raise the unemployment rate to slow wage growth. So this is a whole soup of BS that they're trying to deal with. Basically, unemployment going up in the short term. It's not even worth talking about right now. But it is a lot of just they have a fun little problem to deal with. But anyway, and the Fed will have to bring down demand or raise the unemployment rate to slow wage growth. This speech confirms our view that Powell is on the hawkish end of the FOMC spectrum, possibly more hawkish than the median participant. So what are you trying to tell us, Powell? What is this guy trying to tell us? So in 2 weeks, we're basically going to get CPI data coming out on Tuesday morning at 8:30 a.m. So we have to take that into account. We also have to take into account that the Fed is continuing to talk about having a soft landing. So the only explanation that I have for this, obviously, is if in the next few weeks or whatever, we end up continuing to show some strength for the next, at least, even for the next day. I'm not sure if it can continue, right? But in terms of a soft landing, it would be much softer if the fall happened from up here than it would if it just happened from down here. So that is the only other explanation. Basically, what could end up happening is we could continue showing some strength for the next week or two. And then, can you imagine what would happen if CPI? Can you imagine if we ended up rallying for the next week or two, and then once CPI data comes out, we rally into, we rally back up to 440? But yeah, that would be funny. But yeah, immediately we just have to play things intelligently, and until CPI data gets released, and for now we just have to realize that the continued rhetoric that we've been told is they want to have a soft landing, and they're going to make sure that in the next year, they're basically going to continue aiming to raise rates. So, in the short term, I guess, we could end up breaking above and holding above this falling wedge or rising wedge. So then tomorrow, basically, if we can hold 408, then we can continue up higher. The MACD is still very, very oversold. We can easily continue going on higher. And you can see that the RSI has generally began moving faster than the SPY. The only thing that is not really... So obviously the SPY looks very, very bullish, spectacular, right? The only thing that doesn't look spectacular is the bonds. So the bonds in conjunction to where the SPY is, and into where it was before. The bonds haven't made a new high, and they're still trading below this level of resistance. So these 2 wicks up here, until we get a break and close above these 2 wicks, I don't think that any of these moves are real, right? Like, I mean, they could be real, but the bonds tell like the biggest story. So of course we know that if the bonds are doing well, then the stock market is also doing well, and their relationship is pretty much correlated, right? But the bonds tell like the main story. Obviously, this is a very bullish candle on the bonds, but what we need to see now is we need to see a break and hold above these highs of these candles right here on the 30-year bonds. And until that happens, obviously, like, I'm not going to be completely convinced of the strength that we have in the SPY. The other thing, obviously, that we need to look at is the dollar. And the dollar did have that one green day, wicked up, and then fell very, very sharply. So now, the other thing to take a look at is that the dollar is the lower level of the Bollinger Band is starting to shift upwards. Usually that means that there isn't as, so in the short term, yes, the SPY can continue. So look, the dollar, if the dollar goes down, then the stock market goes up. Okay, the dollar and the overall markets have an inverse relationship. So yes, there is more room to the downside in the short term. Maybe in the next few days, there's more room to the downside for the dollar. But once the dollar gets very close, because every day as we get, you know, closer and closer, the Bollinger Band is going to be increasing. And the more we fall, right, then eventually the Bollinger Band, the dollar is going to be trading aggressively outside of the Bollinger Band, which is going to be very overextended to the downside. Once we become very overextended to the downside on the dollar, then basically the rally that we would see in the overall market can basically come to an end. So with the lower level of the Bollinger Band starting to increase just a little bit here, in the next few days, sure, this rally can continue, but keep an eye on this. And I swear, honestly, like I am completely slacking on crude oil. Like literally whenever crude oil is trading very, very aggressively outside of the bands, any sort of bullish sort of play, etc., we can just play XOP options, and it like they work out really, really well. And yeah, man, we have to we have to take crude oil into higher consideration. Basically, there were so many instances like intraday where I was like, all right, yeah, I think it's a good time to go long on and then they just bounce very, very aggressively. So yeah, we have to take a look at that as well. But the other thing is that we're just waiting for the NASDAQ and the IWM to break above their prior highs. And similar to what the SPY did, basically, the SPY is comfortably closed above everything, right? But the NASDAQ and the IWM have not yet shown as much strength. But yeah, I mean, my overall thesis is don't try to blindly try to basically go short heavily. It's only a time to basically start scaling into puts. If you're scaling into puts, you know, don't do it aggressively, because there could easily still be some more buying pressure in the market. But at the same time, if you're holding on to puts for like a few months out, then you're like, I mean, if CPI data comes out bullish in December, then yeah, your longer term puts can most likely be a little toast. But the odds of that happening, I don't think is very, very high. And I think overall, what we saw today was just people becoming a little bit too eager with their position sizes. Overall, I think like a lot of people either made, I mean, not many people, I mean, I didn't really trade after the stream, right? But people, you can't gamble on what Powell is going to be saying. And you can't gamble your position, like your portfolios away based off of like news, because there's so much about the news that like, and the data and everything like that, that we don't even understand properly. Like, so you would have to have studied a lot for you to get that understanding of, okay, what are the nuanced details of all of these different things? What would happen if the CPI data comes out hot? What does hot mean? This, that, what is going on actually? Once you have those hours of actually trying, because right now, most of us, we trade according to technical analysis, right? You can't, just because we understand technical analysis, you can't automatically assume that you're going to start understanding macroeconomics and how that, you understand how it affects the charts, but there is layers to understanding macroeconomics as well. Like, there's layers to it. Once you understand like what they mean on the surface level, then you can understand what it means on like a few month horizon. Then you can understand what it means on a few year horizon, and then in terms of everything else. But the main thing is just don't over leverage your portfolios on longer term things in this market environment, especially if you don't have the capital to lose, and especially if you don't truly understand like all of these different the data that's coming out and everything like that, and what the data actually implies. Like, what are the implications of the data once they come out, and what does it truly mean? You're better off just scalping, honestly. So there's so much money to be made in scalping, honestly. All it takes, bro, like, if you're throwing, like, even if you're throwing even like 5, 10,000, like, I mean, obviously not everyone has that. Even if you're throwing, not a financial advisor, this isn't financial advice, but if you have like a $10,000 account and you're taking 10 trades a day, you're putting $1,000 into every trade, how much money do you think you would have at the end of the day? Like, no one is doing that because everyone just is trying to get rich quick. Like, they have a $10,000 account, throwing $5,000 into the first trade, and then they have $5,000 left. Oh my God, I gotta make the rest back. Boom, throw another $5,000 into another trade, and you only took 2 trades, and you're down like $2,000 on the account. So like, there's so much money to be made. It's just, don't get greedy. Don't get greedy, and learn new skills, learn new things, and yeah, everything. It's working out really well. It's going to continue to work out even better. And that's the price we have to pay, honestly, as traders. Like, the admission fee to being able to make a bunch of money is, you have to be able to stomach losing it, and you have to not lose your discipline once you are losing it, and you have to control your emotions. Once you can control your emotions, basically look yourself in the eye, calm yourself down, and make the right decisions, then everything else just, it's very simple. But that's the hard part, and everyone has had to go through that, and it is what it is. So I hope everyone makes better, safer trading decisions. Of course, you know, it's all a learning experience at the end of the day, so don't beat yourself up. It is what it is. And yeah, take care. I will see you guys bright and early tomorrow morning. And yeah, make sure you guys have an amazing day. Have a spectacular sleep, and get a lot of rest, and have a good one. All right, take care.